Hi, everyone. Thanks for joining us today. My name is Marche. I'm the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We are thrilled to bring you this educational presentation. Attendees are muted, but we encourage you to ask questions using the chat box. The presenters will answer those queries after the webinar presentation today. If you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question during the presentation, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I want to introduce you to today's moderator. Terry Glaspie is passionate about protecting loved ones now and for generations to come. Drawing on her own life experience and the trials she has overcome, Terry helps individuals and families navigate the different stages of their lives with financial confidence. With her knowledge and experience, Terry can explain the complex financial world in a way that makes sense so that those who work with her feel empowered as they create the best plan for themselves and their families. Terry also works alongside other trusted advisors, such as our presenter, Dina Mabry, to ensure an integrated approach to health and wealth management. Terry, I'm going to turn the time over to you to say a few words and also to introduce our presenter.
Okay, great. Thank you, Marche. I appreciate the introduction and the opportunity to be here today. It's truly a pleasure to spend time with all of you online, and for those of you that may be watching the webinar in the future. You're taking a huge step forward in securing a better future for you and or a loved one by looking at this concept of long-term care. What is it, and do I need it? As the founder and partner of Vector Wealth Management, I have this long-term care conversation on a daily basis because it's a vital and critical part of a successful financial plan for our clients and their families. To give you an example, even my own family has had to navigate these challenges of a loved one needing long-term care. And Dina's family has been through this as well, as you'll hear in her story. And it's an often very trying and difficult situation that families encounter in this position. It's emotional, it's physical, and definitely it's a financial challenge, particularly without proper planning. So for example, my own grandmother suffered many, many strokes, and we got to a place where her care required 24/7 skilled nursing care. And though that was a difficult decision, we knew it was right. We had planned for it. We had money set aside for it. And under the doctor's advice, we assumed, okay, that would be enough. He said about 12 more months, and that should be all. Well, I can tell you the reality is that she required 5.5 years of skilled care. And my grandfather and my parents were not prepared for that reality. And it was by grace and luck and having a team of trusted consultants and advisors that helped us navigate that path without completely devastating results. And I consider our family very fortunate because when we look at the statistics that 70% of Americans will need long-term care of some type during their lifetime, I feel very blessed that we were fortunate, though we didn't do the thorough planning at that time. And that's one of the events in my life that drove me to incorporate this in my practice as an advisor. So our goal today is to work with you and your families and help you build a team of trusted advisors and consultants so that when a long-term care event does happen to your family, you feel prepared, you've done the proper planning, and you have a good outcome. So with that said, I would like to introduce our presenter today, Dina Mabry. Dina is one of our firm's trusted consultants. She's the owner of BGA Premier Insurance Solutions. She's a resource for life, long-term care, and disability insurance. She's been in the industry for over 15 years and is a respected consultant, like I said, to myself, to individuals and other financial advisors. She creatively finds solutions for estate planning, income replacement, and long-term care solutions. And she works with over 60 insurance carriers. And one of the best qualities about Dina is that she draws on her experience out of the pharmaceutical industry to help properly underwrite clients to meet their needs. So without any further delay, I would like to introduce you all to Dina Mabry. Dina, go ahead and.
Thank you. Thank you,
You're
Terry. Thank you,
And-
Marche.
Dina, I'm going to stop my share so that you can share your screen. So here we go.
Okay, let's do that. I'll make that
All right,
bigger.
that's working
Okay,
great.
I'll see that.
Yes.
Okay, so long-term care is so near and dear to my heart. I'm a wholesale broker for life and long-term care insurance. And before I turned 50, I really was concerned about dying too young. I was very concerned about leaving children behind and making sure that my family was protected in the event of my death. So dying too soon. But interestingly enough, when I turned 50, I really started thinking about, oh no, what if I live too long? And now I really switched and thinking, how am I going to be independent financially, emotionally, and take care of myself? So let's talk about long-term care, and let's talk about how to pay for long-term care and knowing your options. In fact, let's back up 2 steps before that. What is long-term care? Long-term care is when you cannot do 2 of your 6 activities of daily living. And those are bathing, toileting, eating, dressing, transferring, continence, or if you have a cognitive impairment. So if you can't do your activities of daily living, or you have a cognitive impairment such as dementia or Alzheimer's, you really do need long-term care, someone to come in and take care of you. So how are you going to pay for this care? This is an interesting picture here. It's my family, and it's getting older as the years go by, but this was our Nani right there in the center, and she's in the white sweater. And she passed away 2 years ago now when she was 91 years old. So our family really did live long-term care and taking care of Nani. And what happened was Nani was living alone, and she was in a mobile home and started falling. She spilled hot water all down the front of her. She was not eating properly, and her care was not what it needed to be. So my mom stepped in and had to help her go into assisted living. And so my mom has daughters, myself and my sister. I have 3 children. My sister has 2 children. So we're just like you. We're mothers, we're sisters, we're wives, we're daughters, we're caretakers. But that when that family need arises, when someone needs care, you don't have a lot of opportunity to plan. And that's why I recommend planning early. So Nani went into assisted living, and there she got excellent care, both emotionally and physically. And she lived almost 10 years in an assisted living facility. And in the beginning, the price wasn't too much, and Nani had a little bit of money to pay for it, but then that money quickly dried up. So mom had to step in to pay for her. Thankfully, she was able to do that, but it did drain mom and dad's retirement savings because they were saving for their own long-term care. So when you look at this picture, you see real families, real needs, real love, and people that really want to plan and make sure that everyone has their independence and is taken care of in life. So what are the options? A couple of the options are insurance, and that's where Terry and I come in and talking about all the different plans, and we'll go into that. But also your assets. People try to say that they can save for a long-term care event. And the reality of that is you could probably save for a year, maybe 2 years of full-time care. But where the real detriment comes in is the stuff we live a long time with, like Alzheimer's, Parkinson's, things that we live but need care. And who knows how long that would be. Another option is family. And I kind of chuckle at that because family usually doesn't want to do that kind of stuff. Family doesn't want to do the bathing and the dressing and the toileting. They want to come over and they want to watch Netflix and hang out. They don't want to do the heavy lifting stuff. And then Medi-Cal or Medicare, and that's an option, and we'll go over that in another slide. And then my favorite is hope and pray. And that's always the one that I say, well, we can do that too, but let's add something else in between that.
I just want to interject here. Those of us who are not necessarily in your state, Medi-Cal is definitely for the California residents, but it'll be different in each state.
Good point. So Medi-Cal would be Medicaid, and Medi-Cal and Medicaid would be a spend down option where you would spend all of your assets. And I believe, I'll defer to Terry, but I believe about $2,500 is all you can have before you can go on to Medicaid.
Can I interject there, Dina, on that,
Please.
since we're there? Is yes, it's actually $2,000. So before that type of benefit kicks in, it's $2,000 in the bank, one primary home and one vehicle. All other assets must be liquidated prior to those benefits kicking in. There's also what they have called a look back period of 5 years. So oftentimes clients will come to us and say, well, I will gift our second home, or I'll gift an investment account to my son or put their name on it, and that'll take care of it. To some extent it will. But trust me, the agencies that monitor these benefits, they do go back, request statements. And if it's within that 5-year window that you've gifted or transferred title, they will assume that you did it to avoid the benefits, spending your own assets to receive the benefits, and they will deny the benefits. So that's important to keep in mind, and also working with a good estate attorney who understands that.
Great, thank you. So let's talk about the good news and the bad news. The good news is you're probably going to live a really long life. But the bad news is you're probably going to live a really long life, and living is expensive. So a lot of us don't want to talk about the bad stuff. We also underestimate bad things happening to us. We don't want to. Look at the year we've just come off of. We don't need any more negativity or any more bad thoughts. So we want to be positive, and we want to help you be positive. So what we want to talk to you about is long-term care is going to cost you something. And it's just a matter of if you're going to pay for it or if someone else is going to pay for it. So we need to change the conversation. We need to say, what are the options out there, and how can you have tax-free money monthly coming in to take care of yourself? Let's talk about a few myths. So there are 4 main myths that we talk about with long-term care planning. And when we survey, a lot of the carriers do surveys and they talk to Americans, and 53% of Americans surveyed said that long-term care is absolutely super important. Yet only 20% of Americans have talked to someone about that, being an agent or a financial advisor. So we hold these misconceptions. The first misconception is it will not happen to me. Ignorance is bliss. And I always kind of joke, because when I meet with clients, normally it's the male component to it, to the couple, but the arms cross and there's always the shaking of the head, like, nope, not going to happen to me. I'm not going to lose my faculties, and it's not going to happen. But we all know that you can't just live in denial. And the statistics do show that 70% of someone turning 65 will need some form of long-term care in their lifetime. The second myth we've talked about, the Medicare, Medicaid will have me covered, and Terry addressed that. What Medicare will do is they will cover 100 days following coming out of a hospital. And we all know that's going to go very quickly. And some people don't even go into a hospital. For example, our Nani never was in a hospital. She was just home, not being able to care for herself. And then the third myth is that's what my savings are for. So I just was working with a darling lady. She was 68 years old, and she had $100,000 in her savings, and that was her long-term care plan. And of course, we all know, depending on where you live in the country, but in California, $100,000 would maybe cover about 1 year, maybe a year and a half of full-time care. And so what we did is we took that $100,000 and we put it into a policy where she had leverage, and there's compound inflation built into long-term care policies. And now her $100,000, depending on when she would go on claim, can more than double for her care. So she was very happy about that, because we all know right now interest rates are so low. So a CD or a savings account is not going to be enough to increase a potential long-term care savings.
And Dina, along those lines, something we often see where your case had saved $100,000 as part of her long-term care is we'll see couples that say the same thing. But what they often don't understand is that $100,000 is there, and it's often used up with the first spouse who needs the care, not understanding or realizing what happens when that spouse is gone. The surviving spouse now does not have access to those assets, and oftentimes is faced with a reduced income situation. Assets have been lost and income can no longer be drawn on them. Loss of Social Security, loss of pension income. So it's not just the loss of assets that is at play at this stage of life. It's more complex than that.
That's a very, very good point. And, you know, as women, just statistically, women outlive men. And so the last thing you would want is, for example, like what Terry said, the husband to use up the money. And then when he passes away, you have the female standing there saying, what about me? What am I going to do now? And then number 4 is my family will be able to take care of me. If anybody on this call has had an experience with long-term care, you know the emotional toll it can take on a family, a loved one giving care. It's one thing to hire someone to bathe you and dress you, but if it's your loved one, a daughter-in-law, a sister taking care, the studies show that the depression and anxiety for the caregiver is so high, and they actually have a decreased life expectancy because of that stress and that additional burden on them. Terry, do you want to talk about this slide?
Yes, thank you. And I'm so glad that you put this in your presentation. When we were working on the slides together, these are exactly the conversations that I have across the table on a daily basis. When we sit down and say, what is your biggest concern? What is it that keeps you up at night? Always it's long-term care and am I going to outlive my money? They're not worried about, are we going to spend too much on vacations? Are we going to spoil our grandchildren too much? Can I afford, to buy a boat or a new vehicle? It's always about what happens at the end, and do I get to live life with dignity and in the manner that I want to and that they should expect to live? Then the second comment is the concerns of, well, will my children take care of me? Will they want to? Or am I now jeopardizing their future because of not having enough assets ourselves? So these top 3, 4 items here on this screen are absolutely the things that's on everybody's mind. We don't talk about it. We don't talk to our neighbor. We often don't talk to our family members about it, but it is real. And they are big concerns, particularly when there's a market downturn. When there's a market downturn, and you're faced with withdrawing money, not only are you taking out $1,000 per se, but if your account value's down, that $1,000 will never recover back if it's in a depressed state. Another feature is oftentimes we see clients that come to us where all of their assets are held in retirement accounts, IRAs. And when you have a care situation where you're having to take money out, and Dina, like you said, a year's worth of care here in California can easily run $75,000 to $100. Well, yes, you need to take that money out and you need to provide care for your loved one. You also have to pay taxes on it. It's still considered income. Where planning ahead, planning early, as Dina said, buying some type of product policy or something along those lines that meets your specific situation, you can have income that is tax-free that pays for care. So there are good solutions out there. It's just a matter of planning early and planning well.
That's great. You know, it's interesting. When I got into this business back in the early 2000s, we did not even start talking about long-term care until 60, 65. And that really doesn't make a lot of sense thinking back on it, because at that point, well, some of us would have more physical ailments, the hips, the knees, the things that are going out as we age, but also you don't have as much time to accumulate the 3% compounding, and you don't,
Exactly.
it's better to plan early when you have income that you can pay for the policy versus waiting until retirement when you're on a fixed income.
We tell our clients all the time is either your best asset or your worst asset. Depends on when you start. And so we are having this long-term care conversation with people in their 40s and early 50s, particularly those that are high wage earners and have assets available now that they can reposition, put it in place, it's set, and they don't have to revisit it after that point. But yeah,
It
time
really
is the
makes a
biggest
lot of
element.
sense. There you go. Makes a lot of sense. I just connected with a childhood friend of mine that reconnected with me off of Facebook. And she said, hey, you do that long-term care? And she and her husband are 54 years old, and they're going to do a policy where they only pay premiums for 10 years, and it's going to be paid up. And she's an attorney, and she said, I'm going to work 10 more years, and I want this thing paid up and done. So it really is smart planning.
Yes.
So here are the statistics. 58% of men and 79% of women age 65 or older will need some long-term care at some point in their life. So I think of this as I'm getting ready to do my annual renewals on my auto and my home and all my other insurance that we all have. If you told me I had a 79% chance of my home burning down, wow, I'd be out there begging for some sort of fire insurance, flood insurance, I don't know, whatever that statistic is. So when we think about that, it's high enough that we can't just ignore these statistics. And as women, we really need to take care of ourselves. So the question is, what is your long-term care plan? And if the plan is to use people that you love, you got to let them know. We got to tell them, listen, you're my long-term care plan. I'm going to need you to bathe me and transfer me and feed me. And unfortunately, the statistics do show that the oldest daughter usually is the one that has to step up. So if you have a daughter and you don't have a plan, you might want to let her know she's your plan. And I kind of joke and laugh about that because I'm the oldest daughter. So you're going to need to know that my parents do have long-term care insurance. So I'm okay. So most people will say, when you say, what is your plan? They'll say, well, I'm going to self-insure. And we talked about that. And we can talk, Terry and I can talk about different ways of why self-insuring really isn't the best option, but you can use your money to leverage for a policy. Selling a home, as Terry said, if you're married or you have a significant other, really you don't want to rely on the home because you still need somewhere to live. And when one spouse passes away, the surviving spouse needs someone to live as well. And then assets. Certainly the assets are something we can look at, but a long-term care policy actually protects your assets. And then you can also leave your assets on as a legacy. So repositioning of funds is really the best way to do it. And there's so many options out there. And I'm sure, one thing that I always hear is, oh, long-term care is just too expensive. Long-term care insurance is too expensive. And it really isn't, as long as you know your options. So what are the reasons? The reasons that you need to address long-term care are living is expensive. Statistics show that women outlive men. So if you are a woman and you're thinking you're going to live a long life and you look at longevity in your family, you need to look at what you're going to do to protect yourself. And then protect against the catastrophic stuff, like we talked about, the Parkinson's, the Alzheimer's, even strokes, where you live. And then if independence is your option or is your desire, you need to know your options. Most policies will allow you to choose if you want to be home, if you want to be in a facility, and you can be in any state you want to be in. So there are no limitations on that. And then the quality of life, coming off of the year we've just had with the pandemic, most clients are talking to me now saying, I don't want to go to a facility. I want to stay home. And I think there's good and bad to both of those options. A lot of people say, well, a facility at least gives you more community and you have activities. Home can be lonely, but then home isn't maybe as restrictive as facility would be. So it's just good to know that if you have a policy or you have options, you can decide. And then travel and lifestyle in retirement. So this was the story of my own parents. My own parents, they got into this place when they retired that they were so fearful about spending money. My mom couldn't buy a new washing machine. They couldn't go on the cruise. She had all these reasons and all these things that were holding her back from living her best life. And the reason that when we finally dug into that, it was because she was so afraid that she or my dad were going to get sick, and she was afraid of running out of money. So once we finally made the decision to get a long-term care policy, it became this relief to her where she thought, now I can spend, now I can take the cruise. Now I know that over there I have this large bucket of money and it'll be tax-free money should I need care. Because the last thing she wanted to do was spend all of her money and be a burden to my sister and I just said the tax-free money, long-term care benefits are tax-free, which is really good. And then proper planning alleviates stress. We know that. I sleep better at night knowing that I am protected and that I'm planning. And the insurance world is changing. I think a lot of you on this call will hear different friends or family saying, oh, I bought a long-term care policy, it's horrible, or I had a rate increase, or maybe the benefits weren't what I thought they were going to be. Education is power. So with that knowledge, we can help you and we can look at the different options. There's been a lot of changes in the long-term care industry where they've actually put life insurance and long-term care together. So if you were to pass away, let's say without using long-term care benefits, at least your premium would be returned in the form of life insurance. And that's pretty nice. A medical event can erode your assets, and there are ways to protect your family. There are also policies that are joint policies, so married couples. And like I said, if you die without using those benefits, your premium will be returned in the form of life insurance. So I always say that's pretty cool because I know that if I don't crash my car, no one's giving me anything back. They just keep taking my money. So at least with these hybrid, we call them long-term care policies, if you do just, let's say, die peacefully in your sleep when you're 100 years old and you never use the long-term care benefits, at least a portion, if not all of your premium will be returned to your beneficiaries. And it's the power of leverage. You know, we know that if you leverage your money, you can have more money. And we just need to start that conversation. The best way is to start the conversation. And here is our contact information. And I'll turn it back to Terry.
Great, thank you, Dina. We do have several questions here. Let me start back up at the top. I always learn something new. Every time I work with you with these presentations, I learn more and more, so thank you. So would you expand on the cost of long-term care again? And I see this with my clients where they will go out maybe online, work with their insurance broker, and it seems like they get the response that if you want this, you're going to pay more for it. Can you talk a little bit about how clients can plan health-wise or what underwriting criteria is with the different products that are out there?
That's a great question. So there's so many products, and as brokers, as you know, Terry, when we work together, we just dive all in. We'll look, okay, how old is the client? And then we do look at different health things. There are carriers that are a little bit more lenient on different things, different medical conditions. And then it really is a function of premium. You know, the more you put in, the more benefits you'll have at the back end. But then I say something's better than nothing. So even a small policy is better than having nothing. And what we want to do is we want to ensure the front end of your care because we don't know, is there going to be a back end of the care? You know, I love planning, but my crystal ball just does not work. I'm always saying, oh, you know, what will I need? We don't know. So let's ensure the front end of the care. So to answer your question is, it depends. You know, we can do different things. We can reposition assets as a single pay premium. Let's say for example, I'm working with a client right now and they're younger, they're in their late 40s, and his mother recently passed away and she had had a long bout with Alzheimer's. So they know that he has Alzheimer's in his family, but they got a fairly large inheritance. And what they're doing is they're repositioning $100,000 as a single pay premium into a joint long-term care policy. They'll pay no more premiums after that. So you can do a lump of money as a single pay, You can do a 10 pay of premium, a 20 pay of premium, or pay as long as you need to. So I sound like an attorney, I know. I say it depends, but it does depend.
Yes. Thank you. Next question asks, what happens if I don't have children? And that's a great question. We see that again all the time. And I'm going to answer, and then Dean, I'll have you step in. It's the same as when you're doing your trust and your estate plan. Who is it that's in your sphere of influence that you trust? Is it a best friend? Is it a niece? Is it an aunt, uncle? So family member, outsider, something that you would trust, that you would ask, would you help me when the time comes, if the time comes, for my long-term care? But particularly, this is an awkward option, not having children. The relationship is not as close, maybe. This is where having a good policy and a good plan in place early really is vital.
Absolutely. Absolutely. I'm working with a lady now, and she's 64 years old, and her husband has cancer. So he's uninsurable right now, and they have no children. And she's getting herself a long-term care policy, and she's paying for 10 years because she wants to preserve her independence. If she doesn't use this policy, she's going to make the beneficiary her trust, and her trust is designated a charity, and her two nieces, should she not use it, should she have the leftover money.
That's the beauty of the environment that we're in now versus years ago when long-term care insurance came out, is you can leave a legacy if you don't use it, where before it was a use it or lose it environment. So that is one of the positive upgrades that we've really seen lately. Got a couple questions here from several people where they have a family member, a loved one that's receiving care. They do have long-term care policies and are trying to file benefits to initiate they're filing claims with the insurance carriers to start their benefits, and they're getting denied. Can you speak to tips or tricks or good advice to help them in this claim process?
Yes. So what I understand with the claim process is with the long-term care policy, you should have a care coordinator at the carrier. So I would work with your care coordinator. But if it is a problem with qualifying, like not being able to do 2 of the 6 activities of daily living or cognitive impairment, you need to work with your doctor to make sure that the medical records are showing that there is a problem with the insurance.
Mm-hmm.
That makes sense?
It does. Thank you. We've got several questions here too, asking or stating a certain age and asking, is this the right time to buy long-term care? While you're healthy and you have the assets available, that's the time to start planning. Again, with these new hybrid products out that allow you to pay a premium over multi-years, it takes some of the stress off of repositioning assets. So maybe you don't feel that you have enough assets right at the moment to buy a policy. If it's a multi-year pay-in, I'm going to just throw an example out there, $10,000 a year. That is much easier to manage working with your finances than coming up with a lump sum of $100,000. So when it becomes very expensive and very difficult is when we wait and we say, okay, I'm ready to talk about it, but I have several prescriptions. I went to the doctor. They're going to run tests for Parkinson's. At that point in time, it becomes questionable whether you will be able to qualify for that type of insurance. So there's not a defined age, there's not a defined benefit amount or how much you should save. It's when you're healthy and as early as possible. Dina, do you want to add to that?
No, I think that's great. Let's just have a conversation. And what
Absolutely.
I like to do too is I like to do pre-qualifications. We'll know real quick. I have direct access to the underwriters at most of the carriers that I work with, and they're so good about, let's just, I just say male, age, whatever, taking this medication and having these problems or these medical conditions. And then they'll say right away, okay to apply, or they'll ask me more questions back, or they'll say no. And unfortunately, it's not a given that anybody will get approved for long-term care. The carriers get to decide.
Exactly. And I was just going to ask you to add on to that. So certain conditions that may result in a decline of acceptance at first, the client may able to go back and apply for insurance in the future. And some medical conditions are just flat denials.
Yeah.
So it does seem like maybe a discriminatory practice, but again, they're taking all the risks. So can you talk a little bit about conditions, particularly cancers and whatnot, different medical conditions that you see on a frequent basis that may cause denial or require reapplication in the future?
The hardest two that we have trouble with is diabetes and then the rheumatoid arthritis. So if you think about it, the diabetes can have some organ issues later on with neuropathies and trouble getting around with limbs, particularly legs. So diabetes is tough, and depending on the control with the A1C and how the medicine is, if it's insulin or if it's oral. And then the second one is the rheumatoid arthritis, because arthritis is going to inhibit movement in the joints. And if there's joint immobility or joint issues, there's going to be trouble bathing, dressing, toileting, transferring, the triggers. Cancer, I've been pretty successful the farther out from cure or how long it's been since diagnosis. So we can definitely address the cancers, especially if it's breast cancer or prostate cancer. One thing that keeps happening to me is, I think it's been COVID, but a lot of people are now starting to go get things checked, being the knee, the hip, the things that we've kind of put off. And now I'm seeing clients starting some physical therapy, getting cortisone injections, and they will not take anybody that is having anything that's needing to be done. So a medical procedure, let's say, for example, you need a hip transplant or a hip replacement, or you need your knee replacement. They will wait until you have done the actual surgery, and then you have to be 6 months post physical therapy. So there's still a way to get approved. It's just you need to be healed.
And remember, we had a case like that we looked at. Healthy 65-year-old fell out on vacation, broke a hip, needed a hip replacement. We had just applied for the insurance. We waited and it went through. There was no problem after that,
Yep.
but we did have to wait a little bit longer.
Well, that's why I tell people procrastination does not pay off when it comes to insurance, because, I mean, if you even just, let's say you fall down the stairs and break your foot, you can't get your insurance. So it's best to do it when we're young and healthy.
Yes. Will you speak about insurance companies in general and how they're positioned financially to not go bankrupt? I know I often get this question, whether it be life insurance, disability insurance, et cetera, is how do I know that I'm paying for this policy and when I need it, they'll be there?
That's a great question. So I don't want to go out too much on a limb because I don't want to overpromise here, but in the industry, no carrier has gone out of business for being insolvent. What happens is another carrier picks them up. So for example, First Colony got bought out by Genworth, Hartford got bought out by Prudential. There's a lot of different carriers that take on the responsibility from the other carrier. Right now in the industry, I mean, it's the elephant in the room with Genworth. Genworth was the big kahuna, was selling all the traditional long-term care policies. And unfortunately, they were so early and they were so big that they took on all of these insureds, but they thought it was going to follow the model of life insurance. And the model of life insurance is people drop off, they lapse their policies. And then what happened with long-term care is people held on to them and they used them. So they are in a financial crisis now because too many people used their policies. And what resulted from that is rate increases on people that currently own their policies. Now that's traditional long-term care, and traditional long-term care needs to be paid until you go on claim. So unfortunately, for example, if you bought a policy, traditional long-term care when you were 50, and let's say you're not going to go on claim until you're 85, you've got 35 years of paying premium and exposure to that rate increase. Well, if you look at the hybrid or the life insurance components with the long-term care riders, you're short paying them and you're not paying premiums for as long, so you won't have the rate increase. And then the carriers have really learned from this mispricing, if you will, that they price things too low, and now the prices are higher. So it's not a bargain. I'll be honest. There is not a bargain or anything free out there. You're going to pay for the insurance, but at least it's priced correctly.
And Dina, this happens in the insurance industry in general, as it gets adjusted based on realities.
Yeah, it does.
I believe we have one final question here. It asked about disability insurance. Is it differentiated from and separate from the hybrid policies we've been talking about? Disability insurance is for when you're working, receiving active income. The hybrid policies we're talking about, as Dina mentioned, is a life insurance along with a long-term care insurance hybrid combination. Unless there's something combined with disability that I'm unaware of. I've not seen it, Dina. Have you?
No, so disability is insuring your income so you can pay your mortgage.
Yes.
Long-term care insurance is providing the money so you can have care. You can either go to a facility or be at your home. So you can have both, but usually disability insurance ends at age 65 because that's when you go on Social Security. Long-term care, there's no end.
Great, thank you, Dina. I don't see any additional questions.
Yeah, although sometimes people do have questions during the outro. So if you have a question, we haven't had a chance to get to it, we will definitely reach out to you, just provide a phone number and we'd be happy to do that. Well,
Absolutely.
this has been such an informative webinar, ladies. Thank you so much.
Thank you.
Thank
And
you.
on behalf of Advice Chaser, we want to thank the organizations that worked with us to bring you the webinar. Thank you to our attendees for attending. Look for an email with a follow-up about Advice Chaser. We're happy to match you with an advisor that's a good fit for you. And I just got to end screen so I can tell you a little bit about Advice Chaser. Like I said, we're all about helping you find an advisor who's a good fit for you, your life and your financial questions, including long-term care, if that's your concern. Our matching service is free to the consumer. So every one of our advisor partners has agreed to offer an initial consultation free to anyone we introduce them to. So all you have to do is go to advicechaser.com and click on the link that says find an advisor. So once again, from Advice Chaser, thank you so much for being here. This has been a very popular webinar. I'm glad to see a lot of people have oh, and we're getting some thank yous. We've got some excellent presentation comments.
Thank you.
Everyone, thank you so much for coming, and we will see you at another webinar very soon. Goodbye, everyone.